Topics with clients have been, now that we're nearing year end, is preparing for 2021. 2020 has been a very different year, but yet the stock market has performed very, very well. So with clients, we're preparing for what, especially with the retirees, what may be the upcoming distributions that you might be having for the next 1 to 2 years, such as, do you have any larger anticipated expenses or capital expenses, such as home improvements or renovations, maybe a new car purchase or car replacement. Let's start to prepare for those distributions now, since the markets have performed well, and rebalance the portfolio at an opportunistic time. Also discussing what their monthly distributions may need to be for this upcoming year from a cash flow perspective. So let's establish the portfolio in a manner that we can drive that income for the upcoming year. And even 1 to 5 years, as we like to implement a bucket strategy of 4 separate portfolios, one being an emergency reserve, the second portfolio being a short-term portfolio for up to 5 years of a client's expected distributions, then an intermediate portfolio for a client's distributions from years 6 through 10, and then a long-term portfolio for those assets clients don't expect to draw from for over 11 years. Basically, a portfolio situated as such helps folks stick to the plan without making any changes or severe changes, along the way, especially, when the markets become a little bit more volatile or uncertainty arises. It helps keep that plan in place, helps clients see through the uncertainty, and still helps them obtain their goals.
I think that is also a really important element to mention when working with an independent advisor. It's about sticking to a particular discipline and implementing, I would say, worthwhile strategies that have proven themselves, such as rebalancing, because so many people resist rebalancing because they love when their accounts are doing really well and that great position they bought is just doing gangbusters, and they don't want to get out of it. But part of the discipline of rebalancing is you're taking some of those gains and reinvesting those either into something that's not performing as well, because we know that investments can be cyclical and have different periods when sometimes they do well and sometimes they don't so well. And so having diversification is really important, and that's part of that rebalancing strategy. But I also liked what you said about making sure that they have cash available for the next year. It's about, yes, having your emergency reserve, which some people don't have at all. Some people are really good about having their emergency reserve, but they forget about those maybe anticipated expenditures that are beyond that emergency reserve, like you mentioned, buying a car, renovations. Let's factor those in too when we're looking forward on that rebalancing. So I like that.
And as you mentioned, rebalancing is a very simple discipline. And really what rebalancing allows you to do is, one, you can at least annually address these types of cash flow decisions as you look forward. And two, rebalancing is a discipline where you are selling assets high that have performed well and buying assets that haven't performed as well with the proceeds. Thus, it helps you manage the risk within your portfolio. We've seen now over the last several years, the stock market has performed very, very well. So if an investor really hasn't touched their portfolio, equities have become a larger percentage of their asset allocation, and they might be taking on more risk than what they may expect. And if we hit a setback, could that change the overall outlook, or could that change their overall efficacy of their retirement plan? So it is important to reassess and your asset allocation as well as your cash flow needs, at least annually to keep things in line with your general expectations.